Why should audits be done and how often is an audit recommended?
Okay. Many times an audit is a requirement when a company has financing from a bank or from a group of private investors. The audit report is required, or it is a requirement that the company is compromised or compromises or promises to the bank or to the private funders, to the private investors, that a financial report will be delivered at the end of the fiscal year. This requirement is a compromise between the company and the lender, with the only objective of certify the healthiness and the soundness of the company in question. The audit report is the summary of an independent accountant, an independent certified public accountant, of the examination done through the accounts and transactions of the company in a particular year. This is what is called the financial audit, the actual audit of the books of the company. In addition of doing an audit because a bank requires, there's also even when there is no financial obligation, meaning that there's no funding from the bank, there are, for example, hedge funds, there are equity funds, there are all the public companies require an audit report, and small companies require that, for example, when there is a process for selling out the company, when the company is being sold, company is in the process of being purchased by another party. Usually the other party requires an audit report. So why is done and why is recommended? It is done. First of all, we only do audit reports when they are needed. And the need, or when it is recommended to do an audit report, is when usually there is a bank loan, when there is, for example, a company selling $100 million, they have a line of credit of $50 or $75 million, the bank will require a audit report. At that point, it's not a recommendation. At that point, it's an obligation. Now, when there are multiple partners in a company and none of them works in the company, it is recommended that the company goes through an audit report. Because one thing is that there are 5 partners, 6 partners, 7 partners in a company of 5 shareholders, 6 shareholders in a company, and the 5 of them work in the company, so everyone has an idea or at least know what is going on in the company. But if none of them work in the company, and there is a manager or a CEO working in the company, and none of the partners and other shareholders are working in the company, they only know the financial statement of the company, but they don't know the operation, they don't work within the operation of the company, it is recommended that the company takes or goes through a process of auditing every year to provide a report to these non-participants or not working partners or shareholders in the company. So that is the key moment when an audit is recommended. It is also recommended when there is a process of purchasing the company. Then external auditors will come to give an idea of the actual state of the finances of the company through an independent audit report.